Okay, I'm very excited to have on the show Dr. Burton Malkiel, who is the author of a book you've probably seen and certainly should have read called A Random Walk Down Wall Street. Dr. Malkiel, real pleasure to have you.
My pleasure to be here.
So I was actually looking forward to speaking to you about so many of the topics you've discussed, but unfortunately we're very short on time. But I want to comment on or ask a question about an article that, interestingly, you had written about 5 years ago about low interest rates. And things really haven't changed much since then. The problem is that as a financial advisor, I'm helping people who are retiring try to get income, but just nothing is available that seems reasonable. What do you think retired people should be doing for income these days in a low interest rate environment?
It's very, very difficult because we really live in an age of what might be called financial repression, where in all of the developed world, central banks have driven interest rates down to basically zero, and in some cases actually negative. Mm-hmm. So I'm afraid there is no easy, no risk solution. I think that unfortunately what this means is that retired people are going to have to take on some amount of risk. And fortunately, there are some things available, and let me mention three of them.
Okay.
First of all, while any sovereign bond that's guaranteed by the government is really off the table because there's no interest there, corporate bonds and I'm not talking about junk bonds here, I'm talking about corporate bonds of good quality companies do give you a reasonable yield. It's not high. I mean, we're in a low interest rate environment. Fortunately, we're also in a low inflation environment. But corporate bonds are one thing. Secondly, there are preferred stocks that they're not bonds, but they have a fixed interest rate. And just to give you an example of one of these, the Bank of America is one of the leading banks in the United States. They are just coming out with a preferred stock issue, and the interest rate will be about 6 1/8%. Now, you know, it's not like a U.S. Treasury bond. You know, it's got some risk, but my sense is that that's a risk that is reasonable to take, and I think that's one way you can get some reasonable return. Finally, for those who want to take on even more risk, I think that there are many dividend-paying growth companies in the world where you can get a dividend return and the dividend is growing over time. Let me give you one example in the United States. We have AT&T, a big, blue chip telephone company. AT&T bonds yield about 4%. They're fine. These are the corporate bonds I was talking about. But AT&T stock, which is riskier than the bond, to be sure, the AT&T stock yields about 5%, and the dividend has grown over time. So for those who want to go out a little further on the risk spectrum, the stocks of dividend growth companies, blue chip companies that have reasonable dividends and the dividends are growing, is another alternative. So I would say corporate bonds, for one, these preferred stocks such as the Bank of America one I just mentioned, or dividend growth stocks would be my advice. It's not perfect advice because it's much more risk than just buying U.S. Treasury bonds, but unfortunately, given the situation we're in today, that's about the only reasonable alternative for retired people.
Okay, so let's try to break this down into some of the subsections. And before we talk about the specific assets that you mentioned, let's talk about this issue of inflation. Inflation, it seems to me, is a very political figure that a lot of people talk about, and in particular, they always like to break it up and they'll exclude something. But one of the areas that for maybe young people like you and me is not a problem, but for older people is the inflation and the cost of health care, regardless of Obamacare and your politics on that. It's costing more and more money. So we say, well, it's very low inflation, but really people who are well into their retirement are paying a lot of money there. Doesn't that count?
Oh, you're absolutely right, that the market basket for retired people, the prices of those goods are rising faster than the general inflation rate. I mean, I do think we're going to be in a low inflation environment for a long period of time because the world is awash with goods and manufacturing capacity. But particularly in the medical area, this is where the rate of inflation is going to be even higher than the general level of inflation. And it suggests, again, that you buy a U.S. Treasury 30-year bond at 2%, and you're just not going to have a positive real rate of return after inflation. So again, what this means is, unfortunately, that you've got to go out. There's no risk way of dealing with this. You've got to go out to some of these 5 or 6% return securities that I was mentioning before.
Okay, so let's focus more on those risks. We're talking to Dr. Burton Malkiel, who wrote the book called A Random Walk Down Wall Street, which has come out in many new versions. He updates them on a somewhat regular basis. Sold well over 1 million copies, I think over 1.5 million copies. He mentioned at the beginning of the show that there are a few tools that retirees could use: corporate bonds, preferred stocks, and dividend-paying stocks. And I'd like to dive into this a little bit more. In fact, let's go in reverse order. As far as dividend-paying stocks, and I know you're disclaiming your comment by pointing out the risk, but the example you gave when I was in stockbroker school, we like to say, when I started 25 years or so, AT&T was considered a widows and orphans stock. And then when I look back, just not in the very, very far history. At one point it was trading around 60. A couple of years later it was at 20. How can a retired person live with that level of risk, even if, you and I can talk about long-term investing, but they're saying, I can't lose 2/3 of my portfolio?
Well, I don't think that all retired people should have simply common stocks. I only would like to do that for a part of what I would call the income portfolio that people need. And if you, again, go back to the middle one that I had mentioned, the Bank of America preferred, I think there you're going to have a much more stable value. So, look, you're absolutely right. The common stocks are going to fluctuate, and there's no doubt that that's why I mentioned it as the third rung, because they're going to be quite volatile, less volatile than the market as a whole, but still going to be quite volatile. But I still think for, let's say, 1/3 of one's portfolio, probably this is still reasonably sensible to do. I mean, if you are so nervous that any time the stock goes down 2 or 3 points, then clearly that's not for you. Then go to the bonds or the preferred stocks. But for those who are, go in with their eyes open, know that there's going to be that volatility, I think that that's reasonable because, and this goes back to your question on inflation, the thing about the dividend-paying stocks of these blue chip companies is the dividends do grow over time, and the fixed income does not grow over time. So again, there are risks and risks, and there are, at least you get paid for that volatility in terms of the possibility of the dividend growing over time to meet the inflation in things like healthcare costs.
Well, let's talk about another risk. Specifically, I'd like to now go to your second choice, the preferred stocks, which, of course, today 6 1/8% sounds great. We would all like to get that. But this preferred stock like this, would you say, is it comparable to a long-term bond? And if interest rates do move up, not necessarily in the next 12 months, but let's say in the next 3, 4, 5 years, what would happen to the price if someone, let's say, buys a $25 preferred stock?
You're, again, absolutely right. If interest rates move up, it is likely that the price will decline. I said at the beginning, I don't have a perfect solution. The price will come down. But I would say this. My sense is that interest rates are going to be low for a much longer period of time than many people anticipate. Again, the world is awash of in manufacturing capacity. We have very slow growth all over the developed world. Even the developing world is slowing down. I think you're right. There is a risk if interest rates rise sharply, but I do not expect that to happen. They'll go up a little, but I think they're going to be lower for longer.
Okay, so the point that we are addressing here is that normally with fixed income investments, and even preferred stocks are like that, when interest rates do move up, the principal value of these investments drops, even though they may continue to pay their dividend, which of course would be very nice today. So now let's finalize the discussion by going back to your first point, which was corporate bonds. One of the problems that individuals have with buying quality, if you buy real quality corporate bonds, you're not getting much yield above the banks. So you have to lower the quality to, I'm not saying to junk bonds, because I would certainly not think that's appropriate for most people to buy individual junk bonds. But, you know, they're going to look in the BBB, BBB minus rating. A lot of oil companies, for example, are there these days because the commodity of oil has dropped in value. And so people are afraid of that. How can someone put together a reasonable corporate bond portfolio that's not going to expose them to huge interest rate risk and or the default risk?
Okay. I believe that what this means is that one would have to be quite well diversified. And I think it almost requires the person to think of buying a fund. And there, I would say, try to get the fund or the exchange-traded fund. There are mutual funds where you go to the mutual fund company, like a Vanguard, and buy the fund, or there's an exchange-traded fund which trades on the stock exchanges of the world, like an individual stock. And these are very well diversified. So I would say an investment-grade corporate bond mutual fund or exchange-traded fund. And here, my one piece of advice is to get one that has a very low expense ratio. Because, all of us who give investment advice have to be very modest about what we know and don't know. But I'll tell you the one thing about investing that I am 100% sure of, and that is the lower the fee I pay to the purveyor of the investment service, the more there's going to be for me. So looking for a fund or an ETF that is sponsored by a company like Vanguard, which is the biggest mutual fund company in the world, is where I would go, but you have to do it with a fund because you've got to be diversified. One of these oil companies could well default, and so you want a very well diversified bond fund, even if it is investment grade.
And just to add on to the important understanding of bond funds as opposed to individual bonds is that the fund itself doesn't have a maturity date. In other words, if you put $100,000, it's not like the fund in 5 years owes you that money, whereas if you were to buy an individual bond, assuming they don't default, then they will pay you back the money at that maturity date. And the one disclaimer I just want to make for everyone listening, I know that both for myself and for Dr. Malkiel, we're not making specific recommendations. If the Bank of America, the AT&T stock, the bonds.
Oh, it's done as an example.
Right, all examples, and be sure to speak with a qualified investment advisor before investing anywhere. Dr. Malkiel, just tell us in the last few seconds, how can people learn more about your ideas?
Well, I have a 11th edition of my book, A Random Walk Down Wall Street, which is just out this year in paperback. And that's certainly one way to do it. There is an edition in Hebrew, but it's not the most recent edition. So I think that will be translated into Hebrew, but for right now, I would say the paperback edition, which has a 2016 publication date.
All right, and that'll be great for all of the listeners in Israel. Of course, people listening to the show around the world, thank you very, very much for your time. We'll put a link to all of that at the show notes of today's show.
My pleasure. Great talking to you. Thank you so much.
You are listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.